you hear me or is, yeah, it's on, right? Great, okay. So, yeah, ladies and gentlemen, welcome to this panel discussion focused on consolidating and strengthening the insurance and reinsurance industry to promote better quality products in Africa. I'm Najwa Iraki, Lloyd's of London Managing Director in Morocco, as well as Managing Partner of AfricaDev Consulting. It's an honor to guide this insightful conversation today. Africa insurance landscape is rapidly evolving, and with that comes the need to enhance the quality of insurance products and services. Our panelists, who I will introduce shortly, bring a wealth of experience and knowledge to shed light on this key topic. Before we dive into our discussion, I would like to highlight a significant development in the industry that underscores the importance of our topic today. Sanlam and Allianz have recently officialized their joint venture. This joint venture, operating as Sanlam Allianz, aims to provide insurance and financial services in 29 African markets, creating the largest Pan-African non-banking financial services entity on the continent with a combined equity value of 2 billion euros. These illustrate the transformative potential of consolidating and strengthening the reinsurance industry in Africa. Let me introduce our panelists who will provide insights on this topic. So we have Mikir Shah on my left, who is co-founder and chief executive officer at Africa Specialty Risks, a managing general agent sourcing world-leading capacity for African risks with HQ in London. Mikir has over 25 years of experience in Africa. Prior to this, Mikir was CEO of AXA Africa Specialty Risks. A highly skilled practitioner with extensive financial experience, Mikir has also previously held leadership roles in large investment banks such as Barclays and ABN AMRO. Alangbo currently serves as the Executive Director of Technical Operations at Cornerstone Insurance PLC, a leading insurance company in Nigeria. He has over 3 decades of experience in the insurance industry, and he has successfully carved a niche as a life insurance specialist. And finally, Patrick Watson, Chief Financial Officer at Turaco, an insurtech company in Kenya. Patrick is a seasoned financial professional with over a decade of experience in impact investing in emerging markets. He's a chartered accountant with experience spanning investment strategy, technology, corporate valuations, and energy infrastructure financing. So now that we've gotten to know our panelists a bit better, let's dive into our first topic, consolidation within the insurance sector. And to start, I would like to ask all the panelists very briefly if each of you can just tell me what are the potential risks or challenges based on your experience associated with industry consolidation, taking the recent Allianz-Sanlam deal as an example. Mikir, please.
Yeah, look, it's been an interesting deal. It's a very big deal as well. So what we do have with this very large transaction is that in some markets, we have 3 insurance companies that are either Sanlam, Saham, or Allianz. And therefore, this consolidation effectively will mean a reduction in choice for the consumers out there by at least 3 companies in some of these markets. However, on the flip side to that, we do have a situation where in Africa, we don't have many international players of scale. We have AXA and Allianz, who really have 7 or 8 markets prior to these transactions. Prior to that, you had AIG with some market space in a few countries, but they've effectively pulled out of Africa. So what we're left with now in terms of international insurers on the ground, you're left with Allianz and AXA. Clearly, this transaction with Sanlam is effectively a merger of some which allows them to pool their countries and their resources together. It does help in the fact that until now, mainly insurers across Africa are either regionally owned or locally owned in general. And what that means is that they serve the local market. They really focus on the SME market and growing that market. Without the balance sheet required to insure businesses of $100 million, $200 million that are now coming into Africa, it's very difficult for them to provide that balance sheet capacity. Sanlam and Allianz, if they were to deploy their genuine financial strength that you just mentioned, $2 billion, should be able to provide a whole chunk of that capacity. However, you know, in Africa, we all know there's a shortage of insurance capacity, so we'll all have to work together, and that's the most important part, is being able to work together to de-risk all the investments coming into Africa.
Thank you. Stephen, any thoughts on this deal?
All right, thank you very much. The topic is very, very important because particularly the case of Sanlam and Allianz. The consolidation is expected to build capacity, but experience has shown that consolidation comes with a lot of challenges, risk associated with it. Risk of integration. Integration is a major issue. Number one, may take time for the two organizations to be fully consolidated. Also, competition is not waiting. There are different partnerships that will have been built and different competition. Now, that will also make the partners to also be a bit understand the other partner that is joining. So it makes business to slow down. Also, the issue of strategic focus. Strategic focus of the two organizations need to be merged. When we talk about the company may decide to put a bit more attention to retail, while other specializes in oil and gas. Now, to be able to consolidate may take a little time, and that market share may be lost. Though capacity, they'll be able to bear more risk. Others relates to human resources, ability to identify and ensure that the team that will be coming together will work together. The risk that is associated, because I'm coming from a background of two companies that merged. In Nigeria, I was CEO of ARM Life, Metropolitan Life, now joined, called Tangerine Life. It goes with a lot of challenges because we have two technology solutions, a system coming together, and you need to match them. Product differentiation, and you need to put them together. So a regulator is another issue, taking time to be able to ensure that those are done. So those are peculiar risks associated with it, even though it's good to have the capacity because of the consolidation, but then it needs to be well thought of to ensure that it achieves the purpose of the combination. Thank you.
Thank you. Patrick, any thoughts on the same question?
Is it useful or not? Is it working now?
Otherwise.
Yeah. So we've been looking at it from a slightly different angle, which is our markets. I mean, our two prime markets are Kenya and Uganda, and we're in Nigeria as well. And Ghana. Historically, our markets have been Uganda and Kenya. And if we're looking at it from the perspective of some of our markets, in Uganda, for example, that merged entity is now 25% of all general insurance,
yeah.
right? Which is fine if it's a developed regulatory framework that's already in place there, but Uganda's moving towards taking more of a risk-based approach. Having a monopoly at such an early stage in the development of the regulatory framework in a country, doesn't mean they're going to be influenced it, but there is risk that it can be influenced in a way which effectively captures the market for them, because insurance is a balance sheet game. The bigger the balance sheet, if they have it early on, they can effectively capture some of that market. The second player in that market is 11%, so they are less than half the size of the merged entity. And so I do think there's a bit of an imbalance at a very early stage in some of these markets that may need to be monitored, maybe. I don't really know what needs to happen there. From our perspective, to be totally honest with you, we're at the complete other end because we're in microinsurance, and there's just merger of two players that were doing the same thing anyway, right at the top 5%, so we haven't really seen any impact on our business.
Sure. Great. I mean, thank you all for those insights. So, I mean, considering some of the challenges we've touched upon, such as cultural integration, reduced competition, and regulatory hurdles, I would like now to shift our focus to link the specialty strategies and insurance consolidation. So, Mikir, based on experience and background in specialty insurance, what strategies do you believe the reinsurance industry can employ to consolidate and build stronger balance sheets in Africa?
Thanks very much. Not sure this one's working. Is it working? Hello? That's working, yeah. All right, great. So, look, we're a reinsurer focused on Africa. We provide our capacity to everybody in the market space that has the right qualities and skill sets that we ask for them to have. We support all high-quality insurers in all of their spaces. We have a very innovative range of products, which we'll discuss in a little bit. And our balance sheet can be used to bolster anybody else's local balance sheet where it might be smaller. And it's not just our balance sheet. We have our own reinsurer in Bermuda and Mauritius, but we also speak on the behalf of 6 other reinsurers globally. So together it's fairly formidable, and so we can provide that capacity. And bearing in mind what we need to have for Africa is a set of insurance and reinsurance products that are specifically designed for our continent. You know, the same products that are available in Europe aren't necessarily relevant for us. We need things fit for us. You're in microinsurance, so you know exactly what I'm talking about. You're in Nigeria, so you know exactly that the challenges in Nigeria are different to the challenges perhaps in the UK. Our modus operandum here is to ensure we actually make our products relevant for the market space to encourage more investment to come in. That's where we're at. We need to encourage that investment to come in and help the continent develop, which is what we're trying to do. So I don't think the Allianz merger with Sanlam and Saham, which is what it is, it's the 3-way merger, and Jubilee in East Africa, let's be honest, it's a 4-way merger in East Africa. That will take years to consummate properly, so I'm not sure how that's going to impact the market space straight away. But in the meantime, we need a broader range of products which we're supporting the market on.
Thank you, Mikir. So, building upon Mikir's insights, where we understood, the importance of specialty reinsurance that play a crucial role, certainly in consolidation by offering tailored products for specific risks. Let's now look into the broader landscape. And Stefan, in your perspective, which measures would help increase insurance penetration in Africa, which is low, while contributing to better quality insurance products for consumers in Africa?
Okay, thank you very much. Very important is the stability of the continent. The stability of the continent will make insurance penetration to be better, to improve. Now, having said that, there are few things that need to be done to be able to guarantee stronger penetration. One is the product that is designed to meet the need of the people. Not just importing product, but importing product to be able to specifically meet needs of the people. I've said that the world is a global place, and the way insurance done in the past is a bit different. Technology is very key for the distribution. So technology need to be, appropriate technology need to be put in place to be able to ensure that easy, affordable, convenient, efficient distribution of the product. To be able to ensure that you reach as many that need a product, so that there can be improvement in the penetration. African is it's important to note that 34% of African population lives below poverty. So the implication is that insurance product is not their priority until there's improvement. Also, 75% of the products of conventional products are not available to the low income earner because they can't afford it. They need small micro insurance product that is affordable, that is useful to them. Competencies in design of product and writing is also very key in ensuring insurance penetration in Africa. To be able to understand the product, to be able to design the product, and also ensure that the product is profitable to encourage the organization to continue to sell to be profitable. So these are key. The support of the regulator to ensure that they protect the consumer. They also support innovation as the insurance company develop the product. These are my thoughts. Thank you.
Great. Thank you. Taking note of Stefan's implied recommendations, particularly the significance of the product affordability, consumer education, the improvement of underwriting competencies and skills, and you spoke about innovation. So, speaking about innovation, how can technology and innovation be integrated into consolidation efforts to improve product quality? And this is a question for you, Patrick. Thanks.
Yeah, I mean, with regards to improving product quality, I think, insurance of yesteryear wasn't very tech focused at all from the whole onboarding process using, and specifically in a lot of the markets that we're in, it's only very recently become technified. So, if you just look at the kind of process that we use for taking somebody through their insurance, the whole onboarding KYC is completely digitized. So that gets the cost down of that. Distribution is done through digital channels, so it's not actually physically meeting people. What we do is we effectively piggyback off the digital channels that most of our microfinance partners have or telecoms partners have, which again, back to the affordability piece, that means that your customer acquisition cost goes down, which then leads into your product pricing. And then moving forwards for actually receiving the premiums payments, that's all done through digital wallets. Again, that's been facilitated over the last 5-10 years. There are a bunch of things that are happening in various countries that we're in around doing kind of, I keep forgetting the word for it. It's direct debits or subscription payments. Hasn't been possible on a lot of digital wallets until, some of the markets that we're in, they are now moving forward looking to experiment with subscription payments, which will, again, facilitate the actual picking up of money and therefore lowering the cost of doing business with a lot of the clients that we do business with. And then I think the kind of, the big one specifically for us, and I think that would be relevant for this consolidation if they decide to expand their market, is a lot of these people that we're insuring were previously uninsured. And a lot of people outside of that top 5% were previously uninsured. So getting that data on people that are uninsured so you can better price the insurance that you're providing them. Because currently, it's completely unknown risk. For the bottom 80% of the market, I mean, Uganda doesn't even take a risk-based approach to insuring people. So that data doesn't exist on people getting insured. Capturing that data allows you to better iterate the products, better price, better value the risk, and better provide the service. So, yeah, we see it as being super useful moving forwards over the next 5-10 years. It should revolutionize the sector.
Thank you. Well, thank you all for your valuable contributions in this first section, which covered a range of challenges and strategies from concerns about reduced competition, cultural integration, regulatory hurdles, to the importance of specialty insurance, consumer education, and digitalization. Now let's transition to the section 2, where we will explore the intersection of food security, micro-insurance, and insurtech. And let me address this question to Mikir. So, Mikir, how can micro-insurance and insurtech contribute to improving food security in Africa?
Okay, I mean, I think it's following on from the previous comments here. Look, we're a corporate and specialty insurer, so we only insure big things. But what we do is provide master policies for people who do insure microinsurance, who do work with the microinsurance market. Our policies cover 2.5 million farmers in East and Central Africa already. So it shows that using technology, and we have been using parametric technology, which is using big data, we can price the risk in a very nice way, which can be subdivided into micro farmers. So we do this already. And actually, we've moved away from looking at weather to actually moving to yield. What really matters to the farmer is, what's his crop yield going to be, and how much has he lost out on because the yield didn't come through? So we're trying to get to the end game very quickly as to that's what's going to make a difference to their lives, and that's using technology. We were also leaders in the Mozambique cyclone cover, which we actually issued in December, just before Cyclone Freddy hit Mozambique twice. Now, all of this is because we used the same technology, the same live time mapping of what was going on with Cyclone Freddy, which hit Mozambique twice. Most of it hit arable land and farming land. Small farmers got impacted, not big cities. And we were able to pay out within 7 days of knowing what the loss was. And again, that helps the small farmers massively, because what they need is money quickly so they can potentially replant another crop to get some more revenue from their land. And I think it's important that we think about how we do that. Now, we do that for farmers, but we do that for all sorts of other risks as well. But I'm giving these examples because they're the ones that are very easily understood by the market, not just small microinsurance risks of other natures that we can do that. So technology is changing, and it's making a difference to farmers in Africa, and we need to keep developing that technology further to make sure more and more people are covered for the unfortunate things that the volatility around climate change brings. Africa was not seen as a natural catastrophe market, but we've now had South African floods, Mozambique cyclone, and Moroccan earthquake. So we do need to cover for these events, even though things are changing because of climate.
Thank you. Building upon Mikir's insight, where he highlighted specifically, the significant role of ASR products for farmers in sub-Saharan Africa. Patrick, you're a specialist in microinsurance and insurtech. How do you use this technology to actually mitigate risks associated with agriculture and food production?
So we insure farmers as opposed to crops. So we don't provide crop insurance, we do farm insurance. That's kind of one distinction, but I think the insurance that we're providing makes the agriculture sector more resilient. And the reason it makes the agriculture more resilient is because it protects income for farmers. And I'll explain why. So for example, one of our biggest clients is One Acre Fund. So One Acre Fund provides inputs, farmers then go away, sow, farm, and then get outputs. Anything happens during that process, that model for One Acre Fund is at risk. So having insurance at the farmer, so health insurance at the farmer level, allows them to get a little bit of income if something happens. So for example, we have a case study of this lady who was a farmer in Kenya, and her daughter got malaria. And so she had insurance for her daughter as well. She had to leave the field for a while, and she received, I think it's between $250 and $500. And you get it through proving certain nights in hospital, but that allowed her to weather the income shock, to then, for that event, not to prove too catastrophic, moving forward, potentially putting 1 acre fund, putting that harvest at risk. And so it allowed her to get through that cycle of agriculture by being able to draw on the insurance as opposed to her savings, potentially causing issues with inputs moving forwards. So we provide resilience there. In addition, 1 acre fund will pay us up front before the harvest because they realize it reduces the risk of the products that they're actually providing to the farmers as well. The only way we can do that is by bundling all of our product into 1 acre fund system and then getting the payments through that, which we wouldn't be able to do. We wouldn't be able to get that outreach without piggybacking off existing digital systems that they've got in place.
Okay, no, great. No, thank you for explaining how it works. I mean, Stephen, expanding on Patrick's insight into the use of some of these innovative technologies, how can the expansion of agriculture insurance in Africa be made sustainable in the long term?
Okay, thank you very much. Maybe I'll just dwell a bit deeper based on data available. In 2021, we have the data that says that 52% of employed, those who are in active employment in the sub-Saharan Africa are involved in farming. Now, in Africa, we have about 55% of the land suitable for farming. Now, but the challenge is the farmers are not structured.
Yeah.
Now, you cannot, so if they struggle to make income, insurance will be the least. So that's the more reason why there's the need for these aggregation, these collaborations among farmers. Now, that will support resources to support them, and they will have enough resources to be able to have insurance, and that will make them to be able to live well. Now, because insurance will take charge of their risk, unforeseen risk, particularly that a lot of risk exposure that climate change is bringing, there will be enough preparation to be able to guard against it or have products that be able to meet that. Thank you.
Thank you. No, thank you, Stephen, for those takeaways and actually your response from an excellent transition for our third and final part, collaboration between industry players and the regulators as part of the future outlook for the industry. So starting once again by our specialist insurance expert, Mikir, how can industry players collaborate effectively to consolidate and strengthen the sector, and what role could the AfCFTA, the African Continental Free Trade Area agreements, play in this?
Great, thanks. That's a really important question. Look, with the Africa Free Trade Agreement now being enacted in 51 countries out of the 54, for global manufacturers to gain access to the continent, they need to put manufacturing in continent. Now, what that means is that they will have to build their production plants at somewhere in one of the countries in the continent in order to create that distribution and a tax-free and barrier-free trade across the continent. In order to do that, we need to de-risk the investments. There's a huge amount of money that's going to be invested in Africa. We need to be able to de-risk that to help the continent grow, to build these factories, to build the distribution across the continent. We, as Africa Specialty Risks, will provide some of that capacity, but we need more capacity. I know we have representatives from Lloyd's here and your Lloyd's as well, so maybe I'm hoping Lloyd's will join us in the journey in this process. So that's the one aspect. That's the first part, is getting the money in and de-risking that investment into Africa so that that can be used. Once it's there, and even today, you need to have trade between different countries on the continent. Now, if it's the first time a car parts manufacturer in Kenya is exporting its parts to a chain of garages in Ghana, they're not going to do that unless they have trade credit insurance. And we don't have that availability of trade credit insurance in Africa at the moment. So we really need to build capacity around local insurers We have this skill set within Africa Specialty Risk, but we need the local insurers to work with us in order to provide end-to-end service for exporters and importers into various countries from other countries. So all of this is important. Yeah, the insurance is required to provide liquidity and success to the Africa Free Trade Agreement. We're part of it. We're putting a digital platform together to make sure it's operating on there, but we do need others to join us. And we have other interests now coming along to help us join us and help connect the dots to make the Africa Free Trade Agreement successful.
No, thank you. Thank you, Mikir, for this excellent response. As we've just heard from Mikir about the importance of effective collaboration and the potential impact of the AFCTA, Stephen, building on these ideas, could you share your perspective on what regulatory changes or initiatives are needed to support those consolidation efforts?
Okay, thank you very much. The part that the regulator plays is very significant in consolidation and insurance penetration. Ordinary regulators are set up to be able to protect consumer. But what you find out is that the regulator gives priority to the protection of consumer and play low on innovations, innovative product that will help support the consumer's business. So, so there's for the regulator to strike a balance to ensure that while they are carrying out their primary responsibility of protecting the consumer, they also support the industry in building product that meets their need. Mm-hmm. Regulators also are expected to be able to support legislations that will support insurance growth. Now, those legislations are expected to protect ignorant consumer who gives priority to other things other than insurance. In which case, if they have insurance in place, their wealth is protected. So regulators are expected to be able to support those regulations. In addition to that, there's the need for flexibility and understanding by regulators. So what you find out is that regulator plays more on the sides of consumer and bring the sledgehammer on the operator. Now, that there's need to balance because the operators, the insurance industry is existing. That's why they're able to protect the customer. If you allow them to die, there won't be protection for the consumer. So they play a major role in supporting product development, innovation, supporting regulation to be able to strengthen insurance in different countries in Africa. Thank you.
Okay. No, thank you. I mean, based on that, let's explore some practical examples, if any. Patrick, could you share any successful, innovative case studies, either in Africa or globally, in terms of increasing insurance accessibility and affordability?
I mean, we're a case study because that's basically that's basically what we do. So, I mean, the collaboration between micro-insurance companies and fintech companies.
Yeah.
One, micro-insurance companies, at least our type of business, cannot work without fintechs and without effectively utilizing the ecosystem that they've already built. So, as I mentioned earlier, that's distribution, that's payments. But at the same time, it also works the other way. It's useful for them to work with insurance companies because we de-risk their product. So, for example, the majority of our client base is fintechs, and they get, they're effectively quite interested in bundling our products with theirs because it effectively de-risks the repayment of those loans. So, with a lot of our fintech partners, we actually embed agents into their call centers. I mean, not kind of like secret agents to call people and sell insurance, but just so that if there are questions or they need to have follow-up conversations with their client base on getting insurance added onto their products, we're literally in the building to work with them. So I mean, I don't want to kind of repeat a bunch of answers I've given beforehand, but it's effectively we use their ecosystem and their infrastructure they've already built, and then we embed ourselves into them, build the API, so we've actually got system integration as well, and that's what allows our model to work.
Okay, great, and thank you for sharing this prominent example. I just would like to turn now our attention to the big picture and for the panelists to conclude. Can each of you share his vision in three words, on what does the future of the insurance and the reinsurance industry in Africa look like for you if consolidation and strengthening efforts are indeed successful?
Look, yeah, thanks. Look, I think the efforts come from collaboration. The more we collaborate, the more we work together to solve the issues that are preventing people to invest in Africa, the better it is for Africa, and the more we work together to de-risk the issues of all people, both corporates, normal people, and also micro farmers and micro needs, the better it is for the continent. We do need solutions that are fit for purpose for Africa, and I think the best people who can provide it are Africans.
Thank you. Stephen?
Okay, thank you very much. So I have some data here that can support so what we're saying. Now we have about $68 billion as insurance premium in Africa. 75% of this premium come from South Africa. So the implication is that once there's instability, security, and war stops in Africa, the potential for growth is massive because insurance will be needed for different activities. Then the SMEs will likely, there will be breathing space. There won't be migration and running from country to country. Now SMEs will come up, and there will be insurances for them. Regulators, once the regulator cooperate as well, they support the growth of insurance. So some of these developing countries there are a lot of opportunities. So once they grow, there will be need for insurance, and insurance growth will be achieved. Right.
Thank you. Patrick?
Can I just step in for a second? You did mention war in Africa, but if we're clear, there's no actual war in Africa. In Africa, we stopped invading each other a while back. It's a blight that Europe should learn from us from, actually.
Thank you.
Successful consolidation for us would be improved innovation and broader access.
Great, thank you. Thank you for sharing your vision on the future of the insurance and the reinsurance industry. Now let's open the floor to any questions from the audience. So, dear attendees, if you have any questions, it's now your time to ask. Now or never.
Thanks for a very interesting discussion. My question to the panel is that it sounded like all of your solutions were heavily digitized, and that digital onboarding, digital distribution was very much the model. My understanding is that 70% of Africa is still unconnected, and many rural farmers are still living miles away from the nearest cell phone tower. Do you see that as a barrier? Is that a barrier that can be overcome? I'm guessing your answer is going to be agents as to how you solve that. But do you see any, is that a real barrier to providing sachet insurance to, smallholder farmers to ensure those people who can't access it digitally?
I mean, yeah.
Happy for anyone to answer the question.
So look, you're totally correct. And it's not just mobile networks. 600 million people in Africa don't have access to electricity. Forget mobile networks. So we do need the continent to develop quite considerably. In order to provide insurance, we are providing insurance to provide electricity. We are using heavy technology, but that can work across the board. The latest product we have is to put a floor on the price of electricity to encourage renewable energy to come into Africa. Obviously, that's been taken up quite quickly by a number of PE funds looking to invest in renewable energy. But there are things like that. Yes, unfortunately for the small farmers, we're in a situation where in certain countries the mobile networks can't do that, but in other countries they do. Yeah, so if you look at East Africa, there is mobile networks virtually everywhere in East Africa, so smallholder farmers have access to that straight away. In other places, unfortunately, it's not always the case. And also, it's important to understand the ability to measure what's going on. Yeah, and we can do that from using satellite technology. There will be broadband available across the whole continent at an affordable price in over the coming 5 years, I believe, and that will change the market space for distribution and for collection of premiums and paying of claims. That's the most important thing. Being able to pay claims efficiently is very important for the liquidity that we need on the continent.
I mean, you kind of answered the question before. We're very focused on working with partners that actually have touch points with all of those farmers. So it isn't necessarily that end point that is digitized, but with regards to doing efficient claims processing, that ultimately needs to come up the other way. And so it is helpful if there's a digitized process there. Obviously, that's not going to happen for a period of time. So it is about making sure that you're working with an efficient distribution partner that can get it out there, whether that's a digital channel or not a digital channel, and just making it as seamless as possible, getting their data from their organization over to our organization so we can actually provide a risk analysis, and there isn't, I suppose, too much friction, which adds cost to the provision of that product.
Thank you. We have time for one more question.
Can I have two questions?
Just present yourself.
Two questions. One to Mikir.
And then
Thanks. Mikir, you've made the very valid point that we're here as the insurance industry to de-risk investments, right? But just before this panel session, there was a private equity session. And as soon as we mentioned insurance, everybody walked out the room, right? So what can we do to socialize this a bit more in terms of consumer education? That's the first question. And the same question goes to Patrick, is there a need for investment in consumer education in your microinsurance area?
Yes, you're right about the first one. They all walked out, yet they won't make any investment into Africa without political risk insurance, without contract frustration insurance or trade credit insurance. It's as simple as that. Doesn't matter how good the investment is, when it comes to Africa, they need these covers. Yet they all left because they didn't realize actually, when it comes to making that investment, that's the first thing they go out. There's a huge shortage of that cover right now, and that's what's holding back investment into Africa. That's what's holding back development of the continent. So you can have a conference like this, but all the investors out there can't do anything without the covers that we're providing. And it's important that they realize that. Perhaps this time next year, when we're at this conference again, for those of us who come again, maybe we should explain that to the conference organizers as a prerequisite for anybody investing in Africa. You need these covers. You know you need the covers. We'll put something together so that you can find a place to get the covers from. Obviously, we're there to be able to do that.
Yes, and that's a big focus of actually, but how do you educate the consumer? And what we're trying to do is, we're trying to look at different models for doing it. Are you doing that by educating the agents and then getting the agents to then educate the consumers, which is really difficult? Are you doing that via text messages to the actual consumer so that you can do educative campaigns that way? We haven't got the answer. We are trialing a bunch of different processes, and it will be different answers for different partners as well.
thank you. So as we conclude our discussion on consolidating and strengthening the insurance industry in Africa, I would like to thank AFSIC for hosting this insightful panel. And Amit, I can guarantee you next year it will be even much larger. And of course, thank you to our expert panelists, Patrick Watson, Mikir, Shah, and Stephen Alangbo, for sharing their thoughts. You've shed light on critical aspects, such as the need for enhancing stability and increasing expertise to mitigate risks effectively and contribute to Africa's economic growth. Ultimately, the journey towards delivering better quality insurance products and increasing penetration in insurance in Africa is complex. However, with innovative solutions provided by some of our panelists today, regulatory measures and collaboration indeed between traditional insurance companies, micro-insurance providers, and insurtech, we can certainly pave the way for a brighter, more inclusive, and more secure future for the African continent. Thank you once again all for your participation, and enjoy the rest of the conference, or go and have some drinks. Thank you.
Thank you so much, Najwa, and to our panelists that